Hey, thanks for joining us again for the second video. This is kind of a part two of the balance sheet for Walmart. So if you're new, we've been kind of walking through the balance sheet of Walmart just to kind of get an idea for the different entries and things so that we can do our own analysis. If you haven't seen the first video, what I would encourage you to do is to go back and take a look at that particular video where we talk primarily about assets of Walmart. And so we break down each category of assets. And if you haven't, I would encourage you to go even further back and take a look at the initial videos covering the balance sheet, income statement, statement of cash flows, and accounting basics, because that really lays a lot of the foundation for some of the things we're going to talk about here. You'll understand the structure of the balance sheet, so assets equals liabilities plus owner's equity, how that impacts how we report information, and why that is true, why the accounting equation is essentially true, and why assets will always equal liabilities plus owner's equity or stockholders' equity, depending upon the composition of the firm. So we're going to cover the second part of the balance sheet in this video, and we're going to talk specifically about liabilities and also stockholders' equity. So to start off, let's go into kind of the general composition here of the balance sheet. So notice that we have current liabilities here, and then we have kind of this remaining category over here with everything that is not a current liability. So if you recall from our discussion in the last video, a current asset represents something the firm owns that has some kind of value that can be converted into cash in 1 year or less. So liabilities, or current liabilities rather, follow sort of that same kind of guideline. The only difference though is we're looking at liabilities that are due within 1 year. So whereas the assets we're looking at our ability to convert them into cash, with liabilities, we're looking at, well, when do we have to pay them? And this is really important for cash flow reasons because, especially large firms, you've got all these different transactions taking place and you've got to make sure that you maintain an adequate level of cash reserves. So you got to determine, well, maybe this liability we can push off for a month because I'm going to pay this one so that we can continue to fund operations. If you think about it, much like a very personal example, so you managing your own personal income and your expenses, you might wait to pay your cell phone bill because you're going to get paid in a couple of days. You're managing cash flow. Organizations and businesses do that as well. They do it on a grander scale though, of course. So when you're looking at the composition of the statement initially, you'll notice that we have just current liabilities and then our other or total liabilities. And so the distinction would be if they're due within 1 year, the firm obviously has to pay very close attention to those liabilities that are become due because that represents a more immediate impact on our financials than would a more long-term liability that we don't have to think about for a period of time. So let's look at the current liabilities. There's two that you see. The first one is what we call an accounts payable. So if you recall from our past discussion on accounts receivable, you remember that we talked about items that the firm is essentially expecting to receive at some point in the future. And so we've as an example, we've, sold a particular good in Walmart's case, and that item was purchased with a credit card, and, the bank is not going to transfer us the money for, let's say, 6 days. So we've essentially provided the good, but we haven't yet been compensated for, what we've offered. So in which case we designate it as an accounts receivable. So accounts payable works in kind of the exact opposite fashion. So here, these are transactions, or these are monies that we owe to other people. And notice it's a relatively large kind of sum of money. It's, $58.5 billion, because remember, these statements are all in thousands. So some examples of accounts payable for Walmart could include items that are purchased from suppliers, and we've been provided with those particular goods because Walmart, of course, is a retailer, and we need to purchase goods, put them on our shelves to be able to sell them and earn revenue. So if we've purchased goods from another company and we've purchased them on credit, and so we've said, you know what, we'll take $10 million worth of this product and we will pay you within 30 days. Well, that would account as a accounts payable. It's money that we essentially owe to others that is going to be due in a period of time. In this case, certainly less than 1 year. Now let's take a look at short current long-term debt. This sounds a little bit confusing because it has current and then long-term in there. And so current would be due within 1 year and long-term would be obviously due in excess of 1 year. But this represents those debts that are going to be due within 1 year. So the first aspect I'm going to talk about is this concept of, short-term debt. And so short-term debt could constitute things that we owe other parties that are going to be due within 1 year. So if we, for example, take out a credit line that is due within a period of time, let's say of 6 months, well, that would be considered to be, short-term debt because we're paying it off in a period of time. Now, the other aspect is this current long-term debt figure that you see right here. And this represents long-term debt. So long-term debt being, it could be a bank loan, it could be bonds that we issued to receive some kind of money that we can in turn pay for, payroll obligations or purchase equipment or, open up new stores. But it actually is coming due. So eventually at some point, even if let's say I sell bonds, which are pretty much like IOUs, and those bonds are, have let's say a 20-year maturity date. Once it gets to, less than year 19, so, once I eventually pay, the bond, matures, and once it gets to, 1 year, that bond is going to now become current long-term debt because we have to essentially pay the par value of the bond 20 years from maturity. So we can no longer count it as a long-term liability because it's going to become due this year. So kind of like if you had a car payment, for most of the time, so you get a 5-year loan for your vehicle, it would be long-term debt. But once it becomes less than a year, well, now you really got to start thinking about, paying that off because of the fact that, it's going to become due. Now, that's not the greatest example because with those types of things, you typically pay them off over a period of time. Whereas with business transactions, particularly bonds, all we're doing is paying interest on the bond. We're not paying for the par value. That becomes due at maturity. So this could be a very sizable amount of money that becomes due for us. In this case, $6 billion, not necessarily a sizable amount when compared to other figures, but looking at our comparative analysis, you would see that, we had a little over 12 billion here, and now we're at less than 6. So we are in the process of paying off some of that short current long-term debt. One thing that I failed to kind of address and really think about is this accounts payable figure, and that is it's $58 billion, which if you think about it, in relation to not only our total current liabilities, but also our total liabilities, that's a very sizable chunk. Again, you're going to see differences in this figure based upon the business model of the company you're looking at. So a retail firm, you're going to purchase a lot of goods utilizing short-term credit, in which case you will have a more sizable accounts payable because of the fact that you're going to be purchasing those goods on credit and you're going to pay them off at a certain period of time, typically within 30 days or so. So, for a firm that doesn't have accounts payable, maybe they deal primarily with services, in which case they're not purchasing tangible goods necessarily. They might have wages payable, which would be more for employees and those types of things as well. Now, notice that there's not an entry for wages payable. That is something that is not listed at all. Sometimes firms will include that under accounts payable. So instead of denoting a separate entry for the money that we're going to pay employees, because if they work for a period of time, we know that that payment's going to become due, they can account for those as accounts payable at times. So we got $65 billion in total current liabilities. Now, what would be helpful to do, and we're not going to do this for this video, but compare the total current liabilities that you have, so those liabilities that are due within a year, to your total current assets to see if you have things of value that could pay for those liabilities. That's a really key determinant if a firm is financially healthy, is if your current assets, which I'm going to abbreviate as CA, is greater than those current liabilities. Because if they're not, that means that within 1 year, you don't have enough, combination of cash and inventory and other things on hand to pay for all the things that are become due. So if the economy doesn't do well, Walmart is obviously a retailer. Their success is driven by consumer spending. So if the economy does bad, consumers don't spend, we could be in a very bad financial position. So moving on through the liabilities, we have long-term debt. Now, this is exactly like it sounds. It's debt. So it's what we owe to other people, which all liabilities constitute something that we owe, specifically a non-owner, meaning someone who doesn't have a financial stake in the company. But we owe this to other individuals. And so this could be loans, for example, that we've taken out with banks. It could be bonds. So we've issued a bond and we owe this at some point in the future. The next item that is a little more unusual that I'm going to spend a little bit of time talking about are the deferred long-term liability charges. So these are debt, so things that we owe that are going to become due in the future that we've essentially put off over a period of time. So they're long-term, meaning that we're not going to pay them for about a year, but they still are some liability charges, some things that we're going to owe potentially at one point or another. So this can include a number of different things. Primary things involve taxes. So if the company owes some type of taxes to a government agency of some kind, whether it's a state, local, or maybe even a federal, agency, then these are the items that we would, or this is the value of those, or could constitute them. You definitely want to take a look at those footnotes within the annual reports, because again, it's going to break down what constitutes a deferred long-term liability charge. Most of the time, you're going to see some element of taxes is going to be included in there. It could also be pending lawsuits that haven't yet been finalized. We know we're going to be owing some type of money. Maybe we should earmark some of that as a liability because we know that it's potentially going to come due. And next we have a minority interest. So this gets really confusing because it generally represents people's financial interest in a company of some kind. So let me give you kind of a brief example and see if I can help with this. So minority interest represents the stake that shareholders have against what we call a subsidiary. And a subsidiary is essentially kind of a business that the company owns. And so what happens is we value kind of the percentage stake that is owned. So usually they have to have at least a majority stake in the company to be considered a minority interest. So let's say they own, or one particular individual, or whether it's a group of individuals, own 50% of our company that's valued at $100 million. Then what we would say is that, the minority interest then is $50 million. So that's what we have set aside. It's really confusing though, because stockholders' equity represents money that we owe to owners, like stockholders, for example, whereas liabilities represent money we owe to non-owners, meaning primarily banks and or lending institutions, banks and bondholders, but also creditors. So you're putting an item that's derived from a shareholder on the liability side, and the reason for that is usually their stake is a little bit more guaranteed, and we certainly want to kind of account for the interest that we have from that particular person, because they're generally going to want, in the event that a financial, or that Walmart in this case has some kind of financial troubles and ends up having to liquidate and those types of things, these individuals want their interest to be taken into consideration, not like a normal shareholder, like maybe you or I, where we're going to be at the whims if there's any money is left over. So their interest is logged on the in liabilities, because again, they have more of a priority in terms of getting paid if things go really, really bad for their stake. So that constitutes all of our total liabilities. So we have $122 billion in total liabilities. We're going to move on to stockholders' equity. Now, stockholders' equity represents, as I mentioned in a prior video, money that we owe to owners. And so these are people that have an ownership stake of the company. Sometimes it's referred to as stockholders' equity. Other times it's referred to as owner's equity. The distinction really is the presence of actual, shareholders. If it's a sole proprietorship or a partnership, then it's usually owner's equity because the owners, stockholders are really the owners and we're the only people involved. But where you have larger companies like Walmart and other larger corporations, then they have stockholders. So they have stock that's sold on a public exchange, and then people can purchase that to, keep it as part of their investment portfolio. And hopefully it increases in value. Not always, but hopefully. So let's look at some of the entries. The first one we're going to look at is common stock. Walmart does not have preferred stock. They only have common stock. And so this is the value of the common stock that has been issued. And so what happens is during the IPO, which is an initial public offering, the company working with an investment bank like Goldman Sachs or Morgan Stanley, those types, will have a share price. And so we're going to say we have a $10 share price. So we're essentially allowing the public to purchase our shares for the first time at $10 per share. And then we are going to sell whatever number of shares. Let's say we, sell, 10 million shares. Then, of course, in terms of what we would have in common stock would be $100 million. So here we have, 323 million, because remember these numbers are in thousands. So this is a pretty significant figure. Notice though that it doesn't really change. So last year it was 323,000 or 323 million rather, and the year before was $332 million. Notice it doesn't really change because this figure does not fluctuate based upon what the stock market does. So on a daily basis, stocks fluctuate in value pretty significantly. This number doesn't change. It's only the issue price of the share. But notice that from 2014 to 2013, or 2013 to 2014 rather, we have less of common stock. And so what this generally means is that the company is doing what we call a repurchase program. So a lot of companies, as a way of trying to give value to existing shareholders, what they will do is if they have extra money available, they will purchase stock and remove it from the market. And what generally happens is that increases the value of the remaining shares as kind of a way to reward investors. The other thing that they usually do, or reason I should say, is when they feel the stock is undervalued, they can acquire it back for less money, and then it could be a valuable transaction for the firm. So as an example, notice Apple has a very significant share repurchase program where they're removing billions of dollars of shares because they had, $160 billion in cash. Well, they wanted to remove some of that from the market to, give some value to shareholders. So that's when you'll see distinctions really. They're not going to fluctuate based upon market conditions. So, what the stock market does, they'll only fluctuate when a company issues more shares or purchases shares, so removes them from the public markets. The next item is retained earnings. And retained earnings is money that the firm keeps or retains rather. So that being the really important word, is money or income rather that the firm retains. So it keeps, so it can reinvest back in the company. When we look at the income statement, this is going to make a lot more sense. But, obviously the general idea is that companies have revenues, right? And then they have expenses, so money that we pay out to earn said revenue, whether it's a cost of goods sold or if it's an operational expense just to run the company. And then, of course, we have some kind of profit, right? What we can do is then we can pay a dividend, so essentially a quarterly payment to our shareholders as a way of rewarding them for their investment. I believe Walmart actually does pay a dividend. And then what we would keep would be our, I'm going to put this down here, would be our retained earnings. And so this is money that we are just going to roll over to another period so that we can use to run our operations. So meet payroll obligations or pay suppliers, or expand and purchase new trucks or build new stores. These are things we're going to keep on hand so that we can in turn, fund operations. Notice though, it's actually increasing. So it's 85 billion in 2015, an increase from 76 billion, which was an increase from 72 billion. Looking through the annual report, if you do, one of the things you'll find is that in large part, this is a result of managing cash flow. So Walmart is kind of managing the cash flow they have as an organization, which in turn means, paying suppliers, the very last minute, but obviously trying to collect your receivables as soon as possible. And so in large part, those are a result of that right there in terms of, the increases. But then you'll look at, things like profitability, of course, which we'll get to in the income statement in a future video. Next here, we have a capital surplus. So a capital surplus is a confusing entry, or it can be, because it institutes what we call a par value into a stock. So let me give you an example. It's going to be really simple, but I just want you to understand the basics of it. So let's say that, our share price is, $10 per share during our IPO. So same thing like last time, but out of that $10, it has a par value of $1 per share. So we're still going to sell $10 million, or 10 million securities, I should say, which means we're going to raise 100 million. But, whoops, I don't know why I did dollar sign. $10 million out of that constitutes the par value. So what'll happen here is that 90 million is going to get reported as common stock. And then 10 million is going to get reported as a capital surplus. And I know this is real confusing because it's essentially the company is like designating money in different areas, but that's kind of a simple example. So Walmart's capital surplus is much higher. It's very significant, $2 billion, whereas their common stock is, 323 million. So that's, certainly a multiple higher than that, but that's generally how it essentially works. And so they're accounting for the value of the transaction differently, and grouping one into the common stock category and the other in capital surplus. So that's generally how it actually works, roughly. And then we have other stockholder equity. And notice that this is a negative figure. So anything in parentheses is going to be a negative figure. So this would essentially mean that this is, stockholders' equity that is being removed from the firm. This is something that, we're essentially going to be paying out for on the balance sheet. Again, you're going to want to look at the footnotes to get a better sense of what's included with stockholders' equity, particularly if it's negative. It's probably a bunch of smaller transactions, but you still want to get a sense of what it is in total. And then last, you've got, your total stockholders' equity here, which is the whole column essentially, added up together, which is $81 billion in total stockholders' equity. So when you take this 81 figure and you add it to the 122 million figure, one of the things that you'll notice is that those two figures will equal the assets that the firm has. And again, the rationale behind that, or the reason, is because firms have two funding sources, either liabilities, so the debt that you incur, or using stockholders' equity, meaning owners' money. So that could include your own money if you're an individual entrepreneur, or include the money of shareholders if you're issuing your stock on an exchange of some kind as part of an IPO.